California's insurance market is not simply shifting. It is undergoing a profound structural unraveling that is quietly reshaping what it means to own a home in this state. And tonight, we take an extended, unhurried journey into the heart of that transformation. This is not the story that shouts from headlines or dominates breaking news banners in bold red letters. Instead, it is a quieter, more intimate story unfolding inside real households, often behind closed doors, where people sit at dining tables with envelopes in their hands, slowly opening letters that contain words they never expected to read. For many, it begins with a simple sentence. We regret to inform you that we are unable to continue providing coverage for your property. And even though the words are printed on a clean sheet of paper, the weight they carry is heavy enough to change the course of an entire family's life. Some homeowners stare at the notice in disbelief, rereading it several times as if hoping the meaning will shift on the third or fourth pass. Others feel a quiet anxiety rise in their chest, realizing that losing insurance doesn't merely mean losing a policy. It means losing the foundation that protects everything they've worked for. Tonight, we examine why insurers are withdrawing from some of California's most beloved cities, why premiums are skyrocketing in regions that once felt stable, and why entire communities are drifting toward the edge of being uninsurable by 2026. And most importantly, we reflect on what this means for the people who still call California home, who still love the neighborhoods where they grew up, and who still believe in the dream of living in a place defined by beauty, opportunity, and promise. Let us begin our journey into the 5 cities where affordability, stability, and security are slipping further from reach. 5 California cities where home insurance is becoming nearly impossible to get. Number 5, San Diego. San Diego has long existed in the imagination as an oasis of perfect weather and coastal calm, a place where the sun seems to shine with a little more generosity, and the ocean breeze carries with it a sense of effortless peace. Yet beneath this familiar postcard image, an insurance crisis has been growing with a seriousness that many residents did not see coming. Over the last 3 years, homeowners throughout San Diego County have reported dramatic increases in premiums, not small adjustments, but jumps so steep they feel almost surreal. Families accustomed to paying $2,000 per year suddenly find themselves staring at renewal notices quoting $3,500, $4,200, sometimes even more than $6,000. And the speed at which these increases have appeared has created a new level of financial strain that many never imagined they would face. The reason lies in how insurers now view the region. While San Diego is famous for its coastline, large portions of the county, especially inland neighborhoods and communities along canyons, hillsides, and brush zones, are now flagged as high-risk areas under updated fire behavior models and catastrophic loss simulations. Insurers have recalculated not only the likelihood of future fire events, but also the cost of replacing homes in a county where construction expenses have skyrocketed. And these combined factors have pushed many carriers to drastically reduce their presence or exit the region entirely. As a result, homeowners who have lived in the same house for decades suddenly find themselves receiving non-renewal notices, forcing them toward the FAIR plan, which offers limited coverage, larger deductibles, and significantly higher costs. And for many, the FAIR plan is not a temporary stopgap. It has become their only available option. San Diego remains a beautiful and desirable place to live, yet by 2026, large sections of the county may reach a point where insurance is either prohibitively expensive or structurally inaccessible, leaving families to navigate a crisis that feels both unexpected and deeply unsettling. Number 4, Chico. Chico, nestled at the northern edge of the Sacramento Valley and surrounded by rolling hills, forests, and natural beauty, has long been known as a peaceful, affordable community with a deep sense of local identity. But everything changed after the Camp Fire devastated the nearby town of Paradise, and Chico became the primary destination for those displaced by one of the most destructive wildfires in California's history. In the months that followed, Chico's population surged as families sought refuge, placing enormous pressure on the housing market and quickly driving prices upward. Yet insurance companies were observing something very different. A region enveloped by dense vegetation, shaped by wind patterns that can turn a spark into a disaster, and influenced by climate-driven fire behavior that grows more unpredictable each year. The result has been a dramatic shift in how insurers calculate risk in and around Chico. Policies that once cost $2,000 per year now cost $5,000, $7,000, or even $9,000. Some carriers have exited entirely, while others have limited the number of policies they are willing to write. Many longtime residents, including retirees living on fixed incomes, are now confronted with premiums that exceed their mortgage payments. Non-renewal letters have become increasingly common, pushing residents toward the FAIR plan, which was never designed to serve as a primary insurance solution for entire communities. And yet, for many Chico homeowners, it has become the only remaining path to maintaining basic coverage. Chico's situation is not unique. It is a reflection of a broader pattern taking place across fire-prone regions. But it stands as one of the clearest signs of how quickly an insurance market can deteriorate when risk, cost, and climate intersect. Now, we move into a region where the crisis is even more deeply felt. Number 3. Santa Rosa. Santa Rosa's insurance challenges did not begin in recent years. They began the night the 2017 Tubbs fire swept through neighborhoods with a force so unexpected and so destructive that it permanently altered the landscape, both physically and financially. Entire communities were reduced to ash in a matter of hours. Homes that had stood for decades vanished overnight. The losses were measured not only in property, but in memories, histories, and the sense of safety that every home should provide. Insurance companies faced staggering claim totals, and while many did pay out, the long-term impact reshaped their willingness to insure the region again at the same capacity. Over the following years, as other fires swept through Northern California, from Sonoma to Napa to Shasta counties, insurers reassessed the entire region's risk, concluding that large-scale wildfire events were no longer rare catastrophes but recurring realities. Today, Santa Rosa remains one of the most challenging insurance markets in the state. Premiums have climbed into unprecedented territory, deductibles have increased, and coverage limitations have tightened. Many homeowners cannot obtain traditional insurance at all and are forced into the FAIR plan, which continues to raise its own rates while offering far less protection than private insurers once did. Santa Rosa's crisis is not the result of a single fire or a single year of losses. It is the result of an evolving climate, constrained insurance capacity, rising reinsurance costs, and the severe mismatch between risk and affordability. And for many families, the emotional weight of living in a community still healing from devastation only adds to the financial strain of trying to insure their home. Now we turn south to a region where millions of people live under a growing cloud of uncertainty. Number 2. Los Angeles, high-risk zones. Los Angeles is vast and diverse, with neighborhoods that range from dense urban corridors to rugged hillside communities that overlook sweeping views of the entire basin. Yet it is precisely those hillside, canyon-side, and brush-adjacent neighborhoods that face the most severe insurance challenges today. Homes tucked into winding canyon roads, built along steep hills or surrounded by natural vegetation, have become exceptionally difficult to insure. Insurers have adopted new fire spread models that consider access roads, evacuation patterns, vegetation density, wind channels, and historical burn zones, and many parts of Los Angeles score poorly under these updated risk assessments. As a result, countless homeowners have received letters informing them that their insurer is not renewing their policy. Some have been dropped after 20, 30, even 40 years of continuous coverage. Others have seen premiums leap from $2,800 to $7,400, or from $4,200 to over $12,000, with some hillside properties receiving quotes in the range of $15,000 to $18,000 per year. This level of cost is simply not sustainable for the majority of families, and as insurers withdraw, homeowners are left scrambling for alternatives. Los Angeles, with its enormous population and varied geography, is becoming a stark example of what happens when risk models, climate, and financial exposure collide. And its struggle brings us to the city facing the most concerning trajectory of all. Number 1. San Francisco Bay Area. The Bay Area, long viewed as the economic powerhouse of California and home to some of the most desirable neighborhoods in the state, is now quietly becoming the epicenter of the insurance crisis. The combination of wealth, high property values, dense vegetation, steep hillsides, and wind-driven fire patterns has created a level of risk that insurers can no longer absorb at scale. Communities such as Orinda, Lafayette, Mill Valley, Redwood City, the Oakland Hills, Los Gatos, Saratoga, and other wooded suburban regions have seen insurance availability shrink dramatically. Many homeowners now pay between $10,000 and $22,000 per year, and those figures continue trending upward. Some families have seen premiums exceed the cost of their property taxes. Others, despite perfect payment histories, immaculate home maintenance, and decades of loyalty to a single insurer, have received abrupt non-renewal notices based solely on geographic risk. The Bay Area's challenge is not just fire behavior, it is the astronomical cost of replacing homes in a region where construction expenses, labor shortages, and material costs have surged. Insurers understand that a single major fire event could result in billions of dollars in losses, and many are unwilling or unable to carry that burden. As more homeowners are funneled into the FAIR plan, the system becomes increasingly strained, raising questions about how sustainable the current structure truly is. And by 2026, entire pockets of the Bay Area may exist in a state where insurance is no longer a reliable or affordable part of homeownership. California's insurance crisis is not merely a challenge of rising premiums or policy cancellations. It is a transformation in how risk is understood, priced, and distributed, and it is changing the meaning of homeownership in ways that are profound and long-lasting. Families who have lived in the same house for decades suddenly face uncertainty they never anticipated. New buyers find themselves navigating a landscape where insurance is no longer a straightforward requirement, but a complex, fragile, and increasingly expensive puzzle. And communities across the state are beginning to grapple with the reality that the safety net protecting their homes may no longer be as strong as it once was. If this deep, calm exploration helped you understand the truth behind the headlines, consider subscribing to California Reality. Here, we take the stories most people overlook and bring them into the light, quietly, clearly, and honestly. More truth, more clarity, more California Reality.